Big tech companies are going to outperform the market. That is the case that I'm going to make in this video. Now, I've done videos on big tech many times in the past, and I've made some of my biggest investments, my biggest gains, and my biggest videos on big tech itself. So this is nothing new. I've been doing the same thing that I've always been doing, but I'm doing it more aggressively in the story fund. I'm basically at this point all-inning big tech. I have Amazon as by far my largest holding. This is a big tech company at a 35% weighting. Then we have Google, we have Microsoft, and we have Apple. And in my other portfolio, I even have more Apple and more Microsoft. So I am all in on big tech. And I think that this is an area where investors get this wrong. They get it frequently wrong. They believe that the best days for big tech is largely over. They believe the companies are too mature to continue outperformance. And they continually believe that the companies are at too high of a valuation. These are all concerns that other investors have, and I want to address them in this video. So we're going to be going over why I think today big tech will continue its outperformance. Now, in order to make my case for the continued outperformance of big tech, I want to address what I call the concerns. And I'll list off concern number one as it being too obvious. A lot of people say, Joseph, it is simply too obvious of an investment. Everyone knows about big tech. They know about Apple. They know about Microsoft. You think that you are able to know something different? And if everyone knows about it, then it's obviously priced to perfection. It's priced with all the information that's all relevant, that's available. So big tech is already priced appropriately to its future growth. That is a claim or concern number one. And this one has been proven inaccurate time and time again. I want to go ahead and just take a look at some of these companies here. I'm aware that everyone knows about Amazon, everyone knows about Google and Microsoft and Apple. These companies are covered by legions of analysts. Wall Street, they have buy-side analysts, sell-side analysts. They have price targets on it. So many people doing research on these companies. But what we find is that doesn't really matter. What I want to show you is a write-up, and this is from MBI Deep Dives, which is mostly borrowed ideas. It's a great Substack. You can find him on Twitter as well. But I want to share a couple different data points he brings up here about a recent write-up on big tech. Here's the data that he highlights over the past decade. If we go back to 2013, big tech, being defined as Apple, Microsoft, Alphabet, Amazon, and Meta, had market caps of Apple being 500 billion, Microsoft 225 billion, Alphabet 232 billion, Amazon 114 billion, and Meta 58 billion. In aggregate, big tech was worth $1.1 trillion at the end of 2012. Over the last 10 years, from 2013 to 2022, big tech collectively generated $2.3 trillion in operating cash flow, slightly more than double their aggregate market cap 10 years ago. So the price that you could have bought all of these companies back in 2012 or the end of 2012, they've since generated over double in operating cash flow than the entire market cap combined. To say it differently, big tech was a form of deep value investing that was deeply underappreciated, even though they are widely followed companies at the time. So the point that he's making here is a point I fully agree with. These companies back in 2012 were also the most covered companies, the most analysts looking at them. They were the biggest companies in the world at the time. A lot of investors had the same assumptions back then that they do now. Well, you can't just buy Apple. That's too obvious. Everyone knows about Apple. Every analyst is covering Apple. Apple's not going to outperform because everything's baked into the price. But the reality is much different. What we see is that even though these companies were the most followed, most looked at, most analyzed companies on planet Earth, they still were deep value. They still were dramatically underappreciated by the market. And not just one of them, all of them. All five of them were dramatically underappreciated. And that's another point that he makes here. It wasn't just survivorship bias of one or two of the companies. It was literally all of them. What is perhaps even more strange is that this underappreciation was not quite specific to one or two companies, but the entire group. No company was, however, underestimated as much as Meta Platforms, formerly known as Facebook, generating $271 billion in operating cash flow, and it was 470% of their entire market cap in 2012. So Facebook was deeply, deeply undervalued back in 2012. So we go back to this concern. Joseph, how do you know anything extra about big tech? It's already widely covered by analysts. Well, it was widely covered by analysts 10 years ago. Apple was the biggest company in the world 10 years ago. In fact, all of these companies were some of the biggest in the world 10 years ago, and they were dramatically, deeply undervalued. In retrospect, these were some of the most deeply undervalued and underappreciated companies in the market. And this sounds very counterintuitive. As big tech grows and there's more analysts covering them and there's more excitement and people looking at these companies, not only do they not get more efficiently priced, but they become less efficiently priced. That sounds crazy, I know, but that's the case. Let's go ahead and take a look at some examples here. I'll try to convince you of this. We have here Dataroma, which has the super investor list. And these are investors that control over $100 million in assets under management. Many of them are notable investors with long histories of outperformance. But then you also have a lot of investors that are doing mediocre. Frankly, I would say around 80% of this list generate no alpha. 80% of these super investors do not beat the market. There's only a handful, maybe 10 to 20% that actually have consistent outperformance. But one of the things I noticed when looking over this list of 78 super investors is, let's just go ahead and take a look at something here. Let's type in Apple. This shows us all the super investors that are in Apple. Now again, there's 78 super investors, and we have one super investor that has a lot of Apple, Warren Buffett. So one super investor has half his portfolio in big tech, and he owns a couple other big tech companies as small holdings, but Buffett has 51% of his equity portfolio, the public one, in Apple. So Buffett's not afraid of concentrating big time into big tech, but Buffett is different than 80% of these super investors. Buffett creates alpha. Buffett is a good investor. He really does better than the market consistently. And it's notable that one of the investors that consistently beats the market has half his portfolio in big tech. On this list, we only have 13 super investors that own any Apple at all. Again, out of 78, only 13 own Apple at all. And then out of this 13, half of them have less than 2%. In fact, over half of them. In fact, only 5 of them have above 3% Apple. So 5 out of 78 super investors own any Apple. And Apple, of course, has been a huge outperformer over the past 5 years. So I asked the question, why do these investors not hold a lot of Apple? In fact, when we look at other big tech companies, we can look at Microsoft. We can see how many own this one. It's more, but it's still not weighted up to the index. Right here is where the index weights Microsoft. We have about 14, 13 super investors in it. And then every other one out of the 70 have underweighted Microsoft. And you can do the same thing for Google and GOOGL. When you combine those and add them together, only around half of the investors even own Google at all out of these super investors, and the majority of them do not have Google overweighted. Some of them do. There's again around 10 to 20 of them that do, but there's around 50 of them that don't. So the majority of super investors still don't invest in Google as well. Now my big question was why? Why do most investors, aside from a few like Warren Buffett that owns a ton of Apple, but most super investors have very little, if any, exposure to big tech? What would be their possible reasoning for doing this? When I do analysis, big tech is oftentimes the best companies in the market at very reasonable prices. So wouldn't super investors be clamoring to own these companies? Why are they so underweight big tech? Well, the answer dawned on me. It's simple. It's basic incentive. These companies are too obvious. Consider this for a minute. I get criticized as a content creator, as an investor, for doing the obvious thing, investing in big tech and buying up the biggest, most profitable companies at reasonable valuations. But I'm not managing other people's money. Imagine if you were paying me to manage your money, and then all I did with it was I bought Amazon, Google, S&P Global, Microsoft, Apple, and Netflix. And I sat it there for year after year after year. Would you really feel like you're getting your money's worth? Now consider the fact that these super investors are running big funds where they get money based on assets under management. They charge 2 and 20, 2% of the assets under management per year and 20% of the gains. So they're charging hefty fees for their services of picking out stocks. And why would all these investors give them assets to management if they did the obvious thing? If they invested in the best companies at the most reasonable valuation? Well, if they did that, they couldn't justify their expensive fees. This is basic incentive. These super investors are incentivized to make it look like they're doing something special and different and unique. They're not incentivized to do the obvious thing, even when the obvious thing is the better thing to do. So it comes down to basic incentive. I believe a lot of the reason that these investors are not investing in Google or buying up Meta like crazy or owning tons of shares of Amazon is they couldn't justify their fees. If they just stick all of their money in big tech, yes, they'd likely outperform, but the investors giving them all of this capital would realize that they don't need to be paying them to do that. In fact, one of the only investors on this entire list of super investors that does not have this perverse incentive of trying to look special and unique and like they're finding these very exciting, unique investments is Warren Buffett. Warren Buffett doesn't charge asset under management fees. There's no 2 and 20 for Warren Buffett. He doesn't charge you to put money into Berkshire Hathaway. He simply is running a business. So his decisions, Warren Buffett's decisions, are simply put, where am I going to get the best ROI? What are the best investments in the market with the lowest risk? And when all of those perverse incentives are removed and they're out of the picture, you have no asset under management fees. You're not trying to look special and unique to justify your high fees. When that happens, what does it result in? He has 51% of his public equity portfolio in Apple. He seeks only a return on investment. That is his only incentive. The only thing Warren Buffett and Berkshire Hathaway wants to do is make money. So these companies being big and well known doesn't make them more efficiently priced. No, it makes them less efficiently priced. People are avoiding buying these companies. Lots of investors with lots of money, billions of dollars of invested capital, are avoiding buying these companies specifically because of adverse incentives. They cannot look special and unique if they buy big tech because they have to justify their management fees. Another investor that I could cite here as one that has a very perverse incentive when it comes down to it is Cathie Wood with ARK Innovation. She's supposed to invest in the most innovative companies in the world. Well, the most innovative companies in the world, objectively speaking, have been big tech. They're the ones coming out with new chips and new experiences, new devices, pushing things further and further. But instead, she's invested in Roku and DraftKings. When it comes down to it, Cathie Wood is charging 0.75 basis points for her fund. And if her fund mimicked the QQQ with an overweighting in big tech, well, why would you justify paying for her fees? She has incentive not to invest in big tech. So these companies are becoming less efficiently priced over time as they grow. Another thing we can look at is even the indexes. They actually go out of their way to curb their exposure to big tech because of concerns over concentration. The NASDAQ 100 plans special rebalance to curb dominance of the Magnificent Seven, which is big tech plus NVIDIA, a couple other companies. The NASDAQ 100 special rebalance will take place before the market open Monday, July 24th, to quote, address overconcentration in the index by redistributing the weights. Now, there's no other reason why. They're not running valuations. They're not running discounted cash flows. They haven't come to the conclusion that big tech isn't deserving of it or their cash flows don't support the valuation and concentration. No, the NASDAQ decided to underweight these companies simply because they're too big. They just occupied too much space in the index. That was it. When you don't have these restraints or incentives, when you don't have to justify an asset under management fee, that's when you find investors like Buffett that have half his portfolio in Apple. When you do have these restraints and incentives, you have people trying to underweight these companies, people not investing in them because they want to look special and smart and unique, and you get underperformance. And I believe that part of the reason that the asset management business has underperformed a simple index like the QQQ is simply because the QQQ had more money in big tech. The best companies in the world that remain at reasonable valuations. Now, moving on to the next concern I get about investing in big tech, it goes something like this. Joseph, these companies have been around so long and they're so big now, the best is behind them, and there's no way they can keep growing like they have. What I see from the future is subpar returns. They're probably going to slow down and stop growing. That's a concern. They're too mature and they're going to stop growing. Let's go ahead and just observe this claim here. I want to first look at a little bit of history. We have the passive income portfolio here. This is my other investment account. And then I have the tech category here where I have two big tech companies. We have Apple and Microsoft. Now, I'm up around 100% total with Apple, but in reality, I'm up 300 and 400% on some buys because I was buying this company all the way back in 2017. I just had less money. That's why the percentage on a money weighted return is 189% because some of the original buys I did on Apple are up over 3x. But either way, I remember owning this company, Apple, when they first crossed the $1 trillion mark, and that hit all the headlines. the first company that's going to cross $1 trillion. $1 trillion mark is enormous for a market cap. And all of the talk was like, this is such a big market cap. Apple's already so big. Where does it go from here? And then I believe it was like a year later, maybe even a year and a half, but it was a short amount of time until Apple went to 2 trillion. It was like it took no time at all. Apple took how many decades to get to $1 trillion, and then they doubled their market cap in a couple of years. Of course, they're doing buybacks at the same time, so the returns look even better. Now, I'll say that the concern that these companies are too big and too mature is a valid concern. They have grown to substantial size, and I think it's reasonable to argue that they might have trouble growing more in the future. But when I look at the growth curve of these companies, I think they're all at different stages. If I had a guess right now, I believe Microsoft and Apple are the most mature. They're the furthest in their growth curve. Then we have Google, which I still believe has a lot of growth ahead of it, especially with cloud. Then we have Amazon, which I believe is the most immature of the big tech companies. While they're all adults, Amazon is like a teenager. It's still, I think, halfway through its growth curve. And even if we look at examples of the most mature one being Apple, we still see growth with this company. I still see a lot of it in different ways. Let's go ahead and just take a look at one factor of growth between Apple and Amazon, which is sports. This write-up showed that ESPN is looking at expanding its distribution, and Amazon with Amazon Prime is a great distribution partner. So Amazon in the future may offer ESPN streaming as an additional sign-on service. This is something where Amazon profits by being a distribution partner for ESPN. And then we have Apple buying up more sports. We have Lionel Messi, who drives a jump in Apple TV Plus and MLS subscriptions. Now Apple has the exclusive rights to distribute MLS. You sign up through their app, and they bought the biggest sports figure, well, at least one of the biggest in the world. I don't know if he's the very top, but he's got to be one of the top. Football or soccer is incredibly popular across the world, the most popular sport, and this guy's the best to ever play it. So Apple bought the best player of the biggest sport. They have it on their service now, and this is one more step in Apple slowly growing in its media properties, competing with Apple TV Plus and entertainment, taking that away from Disney, competing against Netflix, and now they're doing the same thing with sports, competing fiercely with Disney over this. We have Apple pushing further into media and sports. Apple TV Plus lands new documentary event featuring legendary football champion Lionel Messi's celebrated career, his move stateside. This is going to be a 6-part series, so they're following Netflix into the multi-part documentary series. Apple's pushing big into this category. We have Disney struggling in this category against these new big tech entrants into sports. Disney's having a big spat, a big disagreement with Charter. They've pulled their content off of Charter. Now there's 15 million people that can't use ESPN. And Disney's trying to advertise that they have Hulu, kicking people off of Charter onto Hulu. But in that transition, they're likely going to lose some subscribers. Some of them will fall off and not subscribe to ESPN. So Disney's struggling right now. They're having a battle with their legacy distribution, and that's a battle that Apple doesn't have to fight. Big tech's set up better because they don't have these legacy businesses they're dealing with, and they're taking over sports. And now there's a lot of articles, a lot of analysts, people like Dan Ives saying that Apple should buy ESPN from Disney for $50 billion. Apple could pay for this in cash. They could bolster up their streaming services and their sports. That would make Apple the de facto leader in sports if they purchased ESPN. But the moral of the story here is that the growth is not done. These companies have such incredible, economically powerful core businesses that have such wide moats and barriers to entry that they can use those core businesses to invest or acquire different projects and continue growing. This has been the recipe that they've done since their start, and they continue doing it. The government's not stopping them. Other companies can't stop them because of their moat and their market position, and so they consume bigger market share and they find more ways to grow. Now, the next concern I want to address is one that I receive frequently, which is about valuation. Of course, as value investors, we're always trying to buy companies that are underappreciated and the future's brighter than what's currently being priced into the stock. Now, we've gone over reasons of incentive and reasons of why the stocks may be underappreciated, but I want to look at the absolute terms of valuation. So what I have here is the price to earnings ratio on a weighted average for the S&P 500 index. If we want to compare big tech against the S&P 500, we should do it on a weighted average basis of SPY. So going back to 2015 to current day, even with its future projection, we can see the PE ratio of SPY. And this is data that's gathered by Bloomberg. So we have price to earnings ratio. In 2015, it was 17.96 to be exact. In 2016, the PE ratio was 20.55. 2017, the PE ratio was 21.93. 2018, it was 16. 2019, it was 21. And then from 2019 to 2020, the PE ratio jumps. We have the COVID dip, the big recovery, and then stocks start to go up like crazy. It goes to a 28 forward PE at the end of 2020. And then in 2021, it's at a 25 forward PE as we go into the tech mania bubble where lots of unprofitable growth companies sell for very high prices based on stories of the future. So there we have 2021. Then in 2022, it starts to go back down. The PE ratio is 18.22. Right now, the current estimated forward PE of the S&P 500 on a weighted average is 20.14. Well, that's simple enough. We know the average of the market, somewhere around 17 to 20. Right now, the market's trading around a 20. So let's go ahead and compare this against our companies. We have Apple here. Apple is at a 25 forward PE. So it's slightly above the rest of the market. The rest of the market's at a 20, Apple's at a 25. And the free cash flow yield matches what the rest of the market is. So right now, Apple is slightly more expensive than the average company in the S&P 500. Now you can ask yourself, is Apple a slightly better company than the average company in the S&P 500? Does Apple have tools of growing its cash flows that are slightly better than the rest of SPY or are significantly better? Is Apple's balance sheet and market position and moat slightly better than the S&P 500 or significantly better? Because right now it's only being priced slightly above the S&P 500. We have Microsoft, even Microsoft, which has annuity-like income with residual 80% plus subscription revenue, extremely diversified both across the US and across the world and across product base. This company trades at a 27. So a step up in valuation over the S&P 500. Microsoft has gone through an incredible run. I don't think the company's a steal right now, but is Microsoft so overvalued against the S&P 500? S&P 500 trades at a 20. Microsoft is at a 27. This company that has a better credit rating than the US government, has 80% recurring revenue, has multiple growth streams and pricing power across all segments of business, and has a huge cash pile and is buying new companies like Activision with that cash pile. I think this company is significantly better than the S&P 500. I believe Microsoft should trade above a 30 forward PE. We look at Amazon here. Now, Amazon is the only one that I think is very difficult to value this way. It's at a 43 forward PE ratio, but Amazon is a big outlier where they take all of their operating cash flow and they reinvest it back into the company. They don't realize it as profits and do buybacks. So this company's finances looks a lot more screwy. And to do analysis on this one, I have to break apart the ad business, the Prime business, and the AWS business. When I look at the cash flows of that, I see a company that is not trading at a high valuation. When we look at Amazon at a enterprise value to EBITDA, it's traded in line with its historical valuation over the past 10 years. So on a PE ratio, this one's more expensive, but Amazon has always looked expensive throughout its entire history. We have Google here, which this company is optimized for profits. This company's highly profitable. Their forward PE is 17.8. So Google's slightly cheaper than the S&P 500 on average right now and over the past 10 years. This company's selling at a discount to SPY. Now, does Google have a worse balance sheet than the rest of the S&P 500? They have $120 billion sitting in cash. Is that balance sheet worse than the rest of SPY? Does Google have less opportunity to grow in the future than the rest of SPY, with significant investments in cloud computing, with investments in YouTube and Shorts, with investments in Android and investments in all of their search and AI businesses? Is Google a company that has a smaller moat than the average company in the S&P 500? These are questions we can consider when looking at Google. But when I do analysis on this, I think this one's obvious. I think it's such an obvious buy. It's selling cheaper than the market, but it's a significantly better company. You can, of course, throw in Meta as well. This company trades at a 15 forward PE. Now, I don't own Meta because I don't like the social media company aspect of it, but Meta is selling at a discount to the rest of SPY based on its earnings and based on its forward PE. And you'd have to ask the same question for this company. When I look at Meta, I would much rather own Meta than 80% of the companies in the S&P 500. Yet it's cheaper than the majority of those companies. So to summarize these concerns, number one, is big tech too big and too obvious and too covered by analysts to have any outperformance left in them? Are they too efficiently priced now? The answer is obviously no. That hasn't proven to be the case in the past 10 years when these companies were the most watched back then, and it's not going to be the case in the future. In fact, there's a lot of evidence to suggest just the opposite. Because of these companies' vast size, there are many perverse incentives to avoid them as investments and seek other ones. Number two, do these companies lack future growth potential because they've done so well previously and they have less optionality and less opportunities? I think the answer to this one is another obvious no. Although the growth will slow down for each of these companies, it will not stop. And if anything, big tech has proven that the resiliency of their core business model and the free cash flow it generates spawns off different businesses all the time. With the government not stopping their continual growth, there is more growth to be had for big tech. And then finally, number three, are these companies overvalued? When I do a simple valuation comparison on each one of them, again, the answer is no. I believe all of these companies are trading at reasonable or undervalued ranges. So when I look at this again, I find myself just looking at big tech and other companies in the market, of which I study many of them, and I feel like the Bernie Sanders meme, where I'm saying once again, I've decided that big tech is the place for my money to be. And until I find something new that changes my mind, that's where I'm going to keep it. So that's all for now. See you in the next one.